The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento finishing up the pre-Christmas show, for me anyway, because I won't be on Tuesday or Wednesday because tomorrow's my day off, and then we have the holiday on Christmas Day. But we do have a big move up today. Mainly, it appears that the price of apples started all this last night in the markets, and it's continued on to the other things. We've broken into new high ground, even in the New York Stock Exchange Index, which we've not been able to do since November the 18th. We've gone a few ticks above the high that we made on November 18th. So we'll see what happens. The main thing that I would like to talk to you about today is the Bradley model. Whenever I really thought the model was turning down on November the 18th, and of course when we went above that high in the NASDAQ and the Dow and the S&P, it's pretty hard to stay bearish, and we've continued to make new highs as we go right now. But what I'd like to point out to you is that if you'll look at the Bradley model, that if you'll notice that it inverted on October the 9th. In other words, the market was coming down at that point. We were talking about that because it was a perfect fib retracement of the previous low that we had back in August, and so that made a perfect 61% retracement, and then we've broken out into new high ground. What we have happening now is that I believe the Bradley model, if you'll take a look at it, you'll see the red line, which is the inverted model. We're coming into to January. Actually, it's December 31st to January 1st. It's got an orb of 5 or 6 days because it could start any time now, but it literally is the biggest day that we have for the whole year of 2014, coming in on the first day of the year or around that date. Because it's a holiday, it could be a few days before, it could be a few days after, but we'll be able to, take a look at it. I've been studying these markets for, oh my goodness, I started studying religiously in 1965. The first few years I was just, dumb luck using whatever someone told me to use. I'd try it, things were going up, I bought them, they went up. It's pretty simple to make money when everything goes up. But anyway, I've been studying for a long time, and I've got a lot of books, thousands of them as a matter of fact. And some of my favorite books are the books that were written by Roger Babson. He was a speculator that he was born in 1885, and he lived to be about 90 years old. He's the founder of Babson College in, I think it's Gloucester, Massachusetts, and it's a private college, about 5,200 students. Babson was a really strong believer in the laws of Isaac Newton. Basil just told me it's in Wellesley, Massachusetts, where Basil worked. Sorry, Basil, I couldn't remember exactly where it was. I knew it was somewhere there. But one of the things that Babson did was that he was such a believer in Isaac Newton. That was his whole life's passion, was the laws of Newton. And he was particularly interested in the third law, which is the equal of action. For every action, there's an equal but opposite reaction. He was so enthralled with Newton that when Newton's bed, when his oak bed came up for auction sometime in the mid-1900s, around 1925 or 26, I believe, might even been 1936, I'm not sure, but his bed came up for auction. And Isaac Newton bought the bed because on the headboard of the bed was engraved the spiral mirabilis, which is basically the Fibonacci spiral that we look at when we look at the cosmos and everything like that. And so he was really strongly influenced by Newton's law of motion, and then also, what goes up must come down. Unfortunately, the market this time won't come down. It is definitely different this time. There was an interesting article that came out over the weekend that I happened to see, is that this is the fourth time in the past 25 years where we have had the put-call ratio on the CBOE. It's the SKEW, S-K-E-W, the SKU index, and this is the fourth time that we've been at this level. The first time was 1995, which was I believe that was a savings and loan collapse, and in 1998 it happened when we had the Russian default, the Russian bonds, and it was also long-term capital. John Meriwether's firm went bankrupt. It was taken over by basically the Fed bailed them out. Then it happened again in 2007. Those were the three times that it happened, and the fourth time it's happening right now as of Friday. So we'll see if that is, if that is going to mean anything. Maybe it is different this time, but frankly, I don't really think it is. It's just a matter of it's gone higher than most people can think it could go. And when you have the emotionalism that you have with a stock like Apple, because the whole world follows this stock. Everybody loved it at 700. They hated it at 385, and they're starting to love it again at 565. But you'll notice that the big gap up today was not even higher than the high we made back on December the 2nd, so it still hasn't moved a great deal other than today, which is, it's a substantial amount if you're long the stock, and it's a substantial amount if you're short the stock. So these are the things that you want to keep in mind. I want to go back to the Bradley model. Let me finish with Roger Babson. I'm sorry to get off the beaten path here for a little bit, but Babson, he was a really prolific writer. He wrote about 40 books, and he was writing a lot of articles. He had a service called the Babson, I think it was the Babson Institute of Technology or something like that. He went to MIT to school, and he had written a lot of articles about stocks and stuff, and he was very, very good at what he did. He amassed a huge fortune. He was a stockbroker at one time, but he realized that he'd do better on his own, and so he went out, probably much like what Steve Cohen has done with SAC Capital. Only, they didn't have hedge funds back in that day. It was all private money, but that's pretty much what he did. On September 3rd of 1929, he wrote that the market was getting ready to crash, and the reason for his reasoning was the fact that I don't remember all of it, but I remember that the speculative fever was high, as you can imagine, because the Dow was at 381, and the market broke 3% that day. That happened to be the high day in the stock market that lasted for over 30 years, 35 years to be exact, and that was known as the Babson break. It broke 3%, held for a few days, and then started to go down, and then later on it started to accelerate to the downside. All I can tell you, folks, are people telling you that's different this time, and it certainly could be different. I listened to what Basil said. Is there a possibility this thing could go up for 2 more years? Absolutely, because you think that it can't, and it certainly can. There was an interesting article by the chief investment strategist at Bank of America Merrill Lynch, and he made a case for this was a high plateau, much like we had in several other years where the market broke out to the upside, and to see that. But frankly, folks, I don't see that. I'm looking at expanding triangles. I'm looking at volume that doesn't look very good. I'm looking at the advanced decline line that looks absolutely horrible. But maybe everything is really different this time. Possibly it really is different. I don't believe that it is, but we're going to find out right after the first of the year. Because if the market continues up after the first 2 weeks of January, that means that the Bradley model has flipped again, and I had not seen that happen before, where it just keeps going back and forth. It might flip once, but it doesn't flip twice. That October low was a very, very important low. We knew that because when the market was up 300 points on October the 10th, that was telling you that something really, really big was happening at that point, and that it was going to go a lot higher. So we'll see. The number of bulls and bears that we have is, is considerably high, the same as it was in other highs like we've had in, some of the major things. And margin debt is still high, but no one's thinking of that. As a matter of fact, what happened last night, I happened to be, I always like to see what the opening is on Sunday night, and I happened to be looking at it, and the Chinese market is down a tad, as I recall, but the main thing is the interbank rate for the Chinese banks went to 9%, and the last time they had that, they had near panic situation over there. They quickly dropped it to 80 to 5.5%, but it didn't hold. It went right back up to 9% again last night. So they're having a little bit of a problem over there, but no one seems to care, and that's typical of what you're supposed to see when these markets are running like this. People just forget about everything. They throw caution to the wind, and that's what happens. And things keep going higher and higher, and they go up forever, I guess. We'll see if that's the case. So we're going to get an idea very shortly if this is in fact going to be something different this time, or this is in fact a spot where we're going to have a period where we're might have a little bit of a correction. Folks, if this is a big bull market, and it's going to last for 2 years, it's not going to go straight up. It's going to give you some chances to come in and buy it. So just be patient if you're not in. Don't chase it up here is my suggestion. I haven't bought any. I bought some gold stocks, but those have been acting pretty good, and we'll be talking about gold right after we have our break here. So that's the primary thing that I'm watching right now is the gold, because it's acting really nicely for a possible bottom down here. If it could just break another $25, I would just be ecstatic. So if that's will happen or not, I'm not sure. So we'll wait and see if this is going to happen with gold, and we'll certainly cover that, after we have our break here, and we'll be able to, see what's going on with all the things that are occurring with the markets. But we've got the Dow up about almost 100 points now. And, the NASDAQ is still running pretty strong, so it's going to be pretty interesting week for say. But this is these next 2 days are very, very thin because of the holiday, and then afterwards, we have the day after Christmas, of course, and then we have the final, which I think is the 28th and 29th, 30th. So when we come in Monday, this is going to be when the Bradley date kicks in. So we'll see if it's going to be, going straight up into Monday, which it certainly could be, given the fact that, everybody is, acting more and more bullish. The IBB, that technology index that we looked at last week, had made a butterfly. It backed off for 5 straight days. And then the gap up today took out the old high by just a little bit, and we'll see what happens. We've had a request here to take a look at Google, so if you'll give me 1 second here, I'll pull up the chart of Google. And by the way, we are visiting Mark Douglas these next few days, and we have Google gapped up again. Wow, this is really an incredible chart. I guess none of the gaps will ever be filled, so we'll see. We'll put this chart up to take a look at Google here because it is an interesting chart. It's making a 3-drive pattern, but I think it's in a blow-off phase. We've got the Dow up 100. We'll be back after this break. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, The Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and we've got a call from Jackson, Mississippi, our friend Brian. Happy New Year to you, my friend, and a Merry Christmas.
Same to you, Larry. And by the way, on my Christmas list, I've got your book, Trade What You See. I dropped a hint to my wife, so hopefully she'll get it to me. I've never read any of your books, but I did read about you, and I've read a couple of Larry Williams books, and I like his books a lot, and you were referenced in a couple of his books. So,
well, we've been friends for 40-some years, 45 years. Larry and I grew up in this business back in the 60s, and I remember going to Jackson Hole, Wyoming. On my way up there, I stopped in Kalispell back in, I think it was about 82, and his daughter, Michelle, was just born, and she's now a big movie star that's been up for several Academy Awards, so he's been very proud of her. So he's had a very illustrative career in this business. So anyway, what can I do for you, my friend?
Well, I know you were fixing to cover gold, and
sure.
I recently, as a matter of fact, it was Friday, I took a chance, like a double bottom in gold. So I bought some calls on the GLD February 130s and the SLVs. I took the 23, the March 23s. I was going to get your opinion on that and kind of cover that for me.
I certainly would. I'll put the GLD up here. I have to add it. I'm on my laptop here running around, so if you'll give me a second here, I can open this up here and we'll get the GLD we'll look at that. I like the double bottom fact that we're watching, but what I'll do is I'll put up the gold chart. Fact is, I posted gold chart already, but we do have a really nice double bottom in the GLD, and it's making it absolutely beautiful Gartley down here with a perfect ABCD, which is what you'd really like to see. The time and price on this is set out perfectly, and not only that, but if this is a place to look at this thing is from the long side. I've also been watching ABX with American Barrick, and that looks good. But if we go back to the gold chart, you'll see that it has a beautiful ABCD pattern. The time frame was supposed to bottom on the 19th, and here we are. We're out on the 23rd. My hope is that we're going to go down and take out that low down at the 1177 level by just a little bit. That would be equivalent of silver getting down to about 1850 per ounce. And if that's the case and it turns from there, then we've got a chance, for a really big move, because there's very few people, even the bullish guys on gold, have given up. And so that's the time that when the pattern and all this stuff comes together, those are the things that make me, really interesting to look at it. But I do like GLD at this level. I think the risk is relatively small, because if it goes down to new low ground, right after, if it gaps down there or something, you've got to get out of it, especially if there's a big gap down and gold's below 1150 or something like that. Then, gold could go to 800 very easily if everybody's going to move to paper assets. That's, certainly a possibility.
That's what I was going to ask you next. The point to get out of the option would be if gold maybe closed below the 1150 level. Is that what you're saying?
Yes, 1150. The thing that I'm interested in is the long-term 61% retracement on gold from the 2008 low, which was around 600 before we went up to 1932 per ounce. That comes in at 1164, I believe, 1164. Our old low that we made back in June was 1177, and if we just took that out by a little bit, go down to that 1165 and then turn, boy, that would get me really interested, because that's typical of what gold will do. It'll make a new high or new low at a real significant point, and then turn around. We're only about $25 away from that level that I'm looking at, and it's down today, so we still have a chance for that to come in, and we've got the new moon coming in about 4 or 5 days. So actually, it's a week from today. What is today? Today's a Monday, right? I think it's a week from today that the new moon comes in, and that should have enough effect to maybe to get it down there.
So you think it could possibly get near the 140 level if it did make a run, is what you're saying? Possibly.
Yeah, I think it could make it somewhere between 1160 and 1140, and if it gets below 1140, then it's going to be really accelerating to the downside, and you just have to stand aside, much like when the stocks, took off on October the 10th, with the Dow up 300 points, and then continues, you just really say, well, it's going higher. You just have to wait and see how much higher it's going to go. Most of the time, I sit on my hands and don't do very much, and sometimes that's the best thing to do is when you don't have a position at all, even though I nibble at it occasionally, but you just can't stand in front of it. Well, we got a break here coming. Thanks for calling in, Brian. I appreciate it.
Thank you very much. I appreciate it.
You bet, buddy. Happy holidays.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and someone had a question about Amazon, about whether it will fill the gap. It's had several of these, folks. These are exhaustion gaps. I mean, we've seen these many times before. You don't have to, well, I shouldn't say that. You do have to be a rocket scientist, I guess, to figure some of these out. But we've had some pretty big gaps in Google. We haven't had the same thing happening with Amazon. It's still, very strong, and it keeps going up every day near the $400 level. And as a matter of fact, it has a ABCD pattern that could take it, all the way to another 3%, which is nothing. You can make that today up around the 415 level. So that's the main thing. The thing that I watch most of all is the New York Stock Exchange Index. Of course, I'm going to bring that up to let you folks see it because it's been incredibly powerful, except not nearly as powerful as what we've had in the other markets. The NYSE has been very, very lagged to come in to see the markets. We're up today into new high ground for the first time in a long time. But what I've done is I've overlaid the market for the NASDAQ on the New York Stock Exchange Index so that you can see that there's been a huge, if you've been in the NASDAQ stocks, that's the thing to be in. But if you were in the NYSE stocks, you're basically the same price as you were, back on November when we were trading at 10,002 240. Today we're at 10,256. So we're not very much. So that's a broad market. That's over 6,700 stocks of the most highly capitalized and liquid stocks in the world. There are also international stocks that are involved in that. But this is different. This is like what we had in '99 and 2000. The Nasdaq went up for the Dow topped in late January of '99, I believe. The Nasdaq topped on March 24th at a little bit, considerably higher level. I think it went up another 10%, and then gave back 85%. But it's different this time. We don't have speculative things where things are worth nothing and then they go to $1,200 a share. Oh, well, they have Bitcoin, I guess, and there's another one called Doggy Coin, and there'll probably be others that come out here with these currencies that the folks have, to look at these things. But you can't fight it right now. It's very, very difficult for the market to go down at this level here because of the fact that we have, the end of the year. There's no way these guys on Wall Street with these bonuses coming in are going to let this market come down. They're going to buy and support it no matter what it takes. And then we have, the Thursday and Friday, which are active days. And then we should have a interesting day when we come in next week. We have a Tuesday. Wednesday is going to be New Year's Day. So next Thursday, the 2nd, will be the key day. And then we're facing the January effect, which basically means that, the stocks have a tendency to, the small cap stocks have a tendency to gain on large cap stocks during the first few days of the year. It's the first 2 weeks of the year. That's what the January effect means. But this has been going on already, so this effect has been, in effect for quite some time already. So whether that's going to continue or not, we'll wait and see. I'm looking at the sentiment. Oh my goodness, the volatility index. All of these things are screaming, warning. But I'm a technician. I don't look at the earnings and all the other things that people talk about. Those have never factored into things that I look at because I'm just looking at the bar charts, and they're telling you that stocks are still going higher, but I think they're going higher, at a decelerating pace, as we can see by the advanced decline line, and then also the fact that the volume has been very, very poor this year. And the broad market, the New York Stock Exchange Index, is pretty much where it was on November the 18th, but that's not what they report. They report on the Dow Jones Industrial Average, and they report on the S&P, and they report on the Nasdaq, especially the Nasdaq, because these tech stocks are so much in the news that they basically control the market pretty much like they did in 1999. And if you remember, if you can go back that far and you were around, a lot of those stocks that were trading for $150 and $200 a share and higher have since gone into the pink sheets, and many of them have even fallen off the pink sheets, that they're not even worth a few pennies per share now. But at that time, you remember they were going on anticipated sales. Nobody had any earnings. They didn't even have any sales. So it was different that time, but maybe it's not different this time. So we'll wait and see. I have to say what Basil said, though. There is a possibility that this thing could go up for 2 years, because this could be the monster high. That's going to take it to areas where a blow off of some kind that could really be really be spectacular, much like we had in 1929. But folks, these sentiment indicators that we're looking at on the margin debt and the bullish and bearish consensus, all these things that add up to it, these are huge danger signs that the market has not been able to shake off ever. I mean, I'm going back 100 and some years looking at this stuff, and it's never different. It might look different, but it's never different. But it still goes up. Just hang on, and like our friend Alex that come on the air before, use your trailing stop and stay in it until the trend stops. That's the base thing. Remember the words of our famous orator Will Rogers. You buy stocks that go up, and if they don't go up, don't buy them. So that's the simple thing to do, and if you do that, you'll be far better off than if you try to come in and just stay short during some of these incredibly strong moves, which you cannot do. You have to put your risk-reward ratio in and go from that level and see if it's going to be working. Someone asked me a question last night by email. about why the market was up so much, on a Sunday night, and it's a situation where what Apple is such a powerful stock because so many people use the Apple products and everybody thinks that the whole world is Apple. And when that stock moves, that makes everything move. And then once it moves, other things just fall into place, and it just perpetuates itself. That's really what it does. There's nothing fantastic about it. I'm just saying, be careful in here. Let's see what happens here after the end of the first year, right around the second or third. I'm going to have Mark Douglas on. I will tell you when I'm going to have him on. I've spoken to him, and we're going to have him on Thursday, the 2nd of January. I'm going to have Mark Douglas on the show. He's got a new book coming out, and I'm pretty sure he'll want to do it. I have to talk him into it, but I know I'm able to do that. I'll make him an offer he can't refuse. The famous line from the Godfather movie. So we'll watch him. We'll have your questions ready for him on January the 2nd. We'll have Mark Douglas, the author of The Disciplined Trader and Trading in the Zone, on at that time. One of our listeners has asked a question about interest rates. Folks, interest rates are going higher. All you have to do is to look at a bond chart. I'll post one in here. I'll do the note chart because the note chart really is the one that they base the mortgages and our interest rates for the credit cards and all the other stuff that's on here. And I'll put this in here, and you can see that we've had a we've been in a bear market ever since we made that. Oh dear, hold on one second. I've got a little bit of a problem. Let me get this out of the way here, and then I'll be able to put it up here. 1 second here. There we go. We should be okay. As you can see, when I eventually post this chart, which should be hopefully in my lifetime. Okay, just give me a second here, and I'll move this out of the way. Ah, dear. All right, now we're ready. Just give me a second. When you are Italian, you are challenged because you can't walk and chew gum at the same time. Okay, we are looking at the Treasury notes. You'll see they're sitting right at the 786 level. The T-bonds bottomed back on the 6th or 7th of November. December, and but the notes are still going down. We've been going down for a year and a half, and the Federal Reserve tells us that interest rates will be cheap for the next till 2016. Boys and girls, I have some interesting information here that you might want to keep in mind. Those interest rates aren't for us. Those interest rates are for the bankers that are supporting the Federal Reserve, because the Federal Reserve is a private bank run by bankers. So they're the ones that get the interest rates at 0% or 0.25%, whatever it happens is. And they turn around and they give you, what, 0.25% to 0.5% on your passbook account if you have a passbook account. And they still keep your interest rates on your credit card around 9.5% to, if you happen to be, poor credit risk of 500 or less, you probably have to pay 29%, which is just under what the boys from Sicily charge. So this is not for us. This is. I hope you understand when you do that. That's an important thing. Another thing that you got to remember is if you look at the money in your hands, the money that you have in your pocket, take out a bill and look, and it says Federal Reserve note. This money is issued by the Federal Reserve. It's not a division of the United States government. It is not. It happens to be on Pennsylvania Avenue, just a few blocks from the White House and the Capitol, but it's a private bank, Like Andrew Jackson said, you can take all your standing armies and walk them into the sea. Let me control the money supply of a country, and that's what happens. They're the omnipotent ones. And now we have a new Fed chairman coming in who has tremendous credentials. She's very scholarly. She's been with the Fed forever, so it's going to be interesting to see how they pull this. I guess they're going to keep pumping money into the market until it keeps going up forever, which is certainly possible. But they basically told us that they're going to start tapering, and along with that, they said, but we're going to keep interest rates low for 2016. Well, I think it's going to be hard for them to do both, but they probably can. And so the market will keep going up forever. The question that I pose to you is, if this works so good, and this experiment is so good, why didn't they start this in 1913 when the Federal Reserve was founded. And the birthday is tomorrow, folks. I don't know if you know that or not, but the birthday of the Federal Reserve System is tomorrow, from Jekyll Island. In fact, there's a book about that, The Creature from Jekyll Island. And we'll see what we're looking at. Our friend Danny from Atlanta has posted a chart into the Tiger TV, which is quite interesting. It's similar to the one that I put in, where we're looking at around 1174 to 1160 in the gold market. That's what I'm looking for, but I think it's got a real chance that we could get to this level. The key things that I'm watching right now is the fact that the notes have not been able to rally during this whole thing with the Fed, and that means rates should have dropped a little bit, but they didn't. Rates keep increasing for us. They're not increasing for the banks, but they are increasing for us. So we'll see if this is going to be if this is going to be a good support level for interest rates. I mean, they're incredibly oversold. We've been coming down since June. Interest rates have been going higher since June. And if you remember a year and a half ago when we had that huge pattern in the Treasury bonds, when they were making the butterfly pattern up at the 155 level, it was different this time too, that rates were going to continue dropping forever. And of course, they've come down, a great deal. 30-year mortgage rates here in Arizona are already up 25% over the past 6 weeks, and believe me, it's put a big damper on the real estate market here in Arizona. It has really slowed down quite a bit. Part of it is seasonal because not many people buy houses during the holiday season, but after the first year, we're going to see if these rates are going to put a damper on some of these houses and stuff. But we'll let history decide that. We're going to have a little break coming up here pretty soon. We still got the Dow up about 100 points, and things are looking good everywhere. So it looks like we're going to have a pretty good update today. It's going to be hard. The market, I think we have a shorter session tomorrow, and that means that we would be looking at something. I think it's only open a half a day tomorrow, as I recall. That's what used to be open. As a matter of fact, years ago when I worked at Drexel Burnham, we never worked on December, and I've never tried to do that in December. I always scale down quite a bit. The old adage is if you haven't made your money in the first 11 months of the year, you're probably not going to catch up with it in December. That would be my guess of what we're looking at. So, it's going to be quite interesting. I only have got a little break here coming up, but I wanted to wish everybody here at TFNN, all of our speakers, and Tom O'Brien and his family a wonderful Christmas and Happy New Year. Thank him for bringing everybody together here with all the great information that you have here with, everyone. Andy, Steve, Basil. It's just been great. It'd be nice if we had Bud Rolfe come on once in a while, because we certainly miss him, and we certainly miss our friend, our good friend Ed Young. But that's how things go. Anyway, we'll see what happens with these markets right after the first of the year. This is going to be a real interesting time because of this thing. We got the Dow up about 100, NASDAQ up 30.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, I posted the chart for the Dow Jones Industrial Average with the inverted Bradley model that I spoke about when we first started the show. I think that's important enough to go over it again. We made the bottom in October. The market inverted at that time. We were making a perfect 61% retracement into that low on October the 9th. I believe the next day the Dow was up 300 points, signaling that it wanted to go much higher. We finally taken out the highs of November the 18th on the New York Stock Exchange Index by about 20 points, 10,260 versus 10,252, I believe. So we have made new highs. Everything is green light all across Wall Street, but there are cautionary signs coming in, the major ones that I've mentioned many times before. We'll go over them one more time. We have the bullish consensus as high as it's been since 1929. That also includes 1998, 2000, 2007, and also 1929. We have margin debt as high as it's been in 1929. And believe me, folks, they don't let people that borrow money to buy stocks win very often. Maybe this is different this time. We'll see. But my suggestion is just to be extremely careful in here. We are looking for a potential bottom in the gold market if we could get one more move down to that 1170 area and see that if it is holding, the gold stocks have started to hold relatively well. And I did post a chart for silver a little earlier into Tiger TV, and that's interesting because silver has not taken out the lows of the last few days, whereas gold has. Silver has held above the 786 this time, which this divergence is telling us that, we do have, some positive things happening from a technical basis. If we could just get some people to come in and either be a buyer or seller in the silver and gold to get the liquidity back up and volatility back up, that's what we really need to get the market moving. So that's the best thing that I'm looking at for a potential bottom in here. The gold stocks appeared to be bottoming. Basically, the two I watch are Newmont Mining and American Barrick, but they look like they're beginning to hold this level. So that's what we're watching. So we'll be watching that very, very closely in the next few days. I want to wish everybody a Merry Christmas again. Everybody that listens in, that calls in, and those that don't call in, I think it's great. I enjoy hearing your emails and and some of the comments that you make, which are quite funny, and some are not quite so funny. But anyway, it's still very interesting. But we really owe a great thanks to Tom O'Brien for putting this all together. He's done a superb job with the group of folks that he has here. You have Basil keeping you in the market all the time, and one of these days I'll be right, and the top will come, and we'll all be very, very happy if we're on the short side. But you don't have to be short here. You just wait because this is the end of the year. There's no way they're going to have this market down big until at least till after the first of the year, is my opinion, because there's too much at stake. They have their bonuses coming in, and they don't have any skin in the game, folks. It's not their money. These hedge fund people and the mutual fund people, so they can do whatever they want. It's a totally different story than what we're exposed to. So that's the main thing that we've got to keep in mind. Just hold your powder dry and wait and see. This contrary opinion thing that we've been looking at, and the margin debt, and also this put-call ratio that has hit an all-time record this week has also been something that gives a red flag. Live every day in an attitude of gratitude, and may God bless, and happy holidays to all of you.
What's the one thing that pulls people back from the breakthrough that they're moving towards? What's the only thing that really stops people from taking action? You and I both know the answer, and sure, we can come up with the reasons why we're not where we want to be, but the only reason that we don't do more with our life is fear. Or if you're an overachiever, call it stress. Simply put, there's something that happened to us in our past that's holding us back from the life we deserve, yet you and I are okay, we're here. So why should we let our past control our future? Exactly. We shouldn't. Hi, I'm Steve Rhodes with TFNN.com, and when it comes to your trading and investing, I can help you overcome your fear of loss. Together, we'll turn weakness into strength with a system I've developed called Mastering Probability. I'll teach you how to make your money work harder for you than you do for it. I'll teach you the tools that provide financial freedom. Go to the homepage of TFNN.com, click on my name, Steve Rhodes, and begin your journey of mastering probability risk-free. It's time to become a pioneer of your future versus a prisoner of your past.